in investments that have rate volatility. I think that if people ask for forecasts, I don't know what's going to happen in 6 months, and whatever I'm thinking, I'm sure it'll be different. But you need to be disciplined, and there'll be surprises that come up. And you know, if you look at what's happened in the markets, there's so many surprises. I mean, there's been Hurricane Sandy, that's a surprise. 9/11 was another tragic surprise. And then you'll have some good news will come over. All of a sudden, the economy's chugging along. Unemployment's better than expected. That's not a shock, but that will be a real positive. Or we could have interest rate or other changes, and some of them will come out of left field. I mean, I use as an example something I do not think is going to happen. But if China decided yesterday that they were fed up with us for some reason, and they were not going to allow, they're not going to buy any more U.S. dollars, and they were going to try to sell some of them. Now, they have 1 trillion of them. They're going to hurt themselves. But if they did that, the bond markets and the currency markets would be in flux. The U.S. dollar would plummet. Interest rates would skyrocket. Now, I don't think it's in Chinese interest, but if we had a confrontation, the more money that's held overseas of our debt, the less leverage we have. So something like that could happen that people didn't foresee. I don't think that's going to happen, but there'll be something else that someone didn't forecast. I mean, there are so many surprises. Did you have a question, sir, before? I didn't see it back there? No? Did anyone else have a question? Yes, sir.
For your clients that are currently retired and needing income, how are you generating yield for those clients? Because yields are so low, particularly for holding very short. Okay. So how are you helping them to create yield?
We can't. We tell them. And if they have enough resources, whether they take principal or income over time, there's a tax consequence of the income, and you can try to optimize. But if the choices are to go out with long-term, low-quality bonds to make 4, 5, 6, 7%, or make zero short-term, I take zero in a minute because of the risk. We tell people that, and it's amazing if you're honest with people. I mean that's our advice. So you have to live off principle for a while. That's a lot better than getting, finding some gimmicks. And there are so many gimmicks out there. We see one of the things theoretically. If there are any professors here from the business school, I'd love to get a study. I don't think there's a way of proving this, but as a theoretical thing, there are stocks out there that pay 8, 9, 10, 11% dividends. Okay? Either we're a way of having a situation that were empirical, which said, what happens if the company cut their dividend to a very small number, but there was nothing wrong with the company? What happens is when a company cuts its dividend, virtually always there's a problem. So the market reacts to the problem. Their earnings are lower, something terrible will happen, right? But let's say there were a way where a company just said, we're not going to do this anymore, but we're doing fine. There really isn't any change. My thesis is that stock would get pummeled. And that dividend is artificially raising the stock price because people are desperate for yield. And I wouldn't want to touch that because the value's not there. Yes, sir.
You're very clear about protecting assets. I'm curious with your clients, what are some of the gimmicks that they tend to bring to you? They've heard this is the way to go. So what are the things out there that are trying to attract them away from the approach that you suggest?
Thank you. We have very close relationships. They may come in with an investment idea. I remember years ago when tax rates were even higher than today. And I'm going back decades. And there was the ability, and many of you may not remember this, you could buy an investment in a partnership. And I'm a little technical as if you're not in accounting, and I hope I don't lose too many. But if you put $100,000 in, you could write off $300,000 or $400,000 or $500,000. Okay, you were allowed to do that. You can't do that anymore. If you have $100,000 in and you're not at risk for any more, you can't take a deduction for more than your investment. But in that era, somebody would come in and if they had 65% federal, state, and other taxes or something, they said, I can get this much money back. And by the way, when I went through the perspective, I'm thinking of many in specific. I remember a real estate one that I looked at for this client, and so many anecdotal stories. The commissions on this for sales were incredibly high. And they have a general partner who put it together. And guess who the brokerage firm is? It was an affiliate of the general partner. Okay. They have a managing agent to manage the property. Guess who's the managing agent? An affiliate of the general partner. They bought insurance for the partnership. Guess who the insurance company was? An affiliate of the general partner. And they had a real estate broker. Guess what? And I'm looking at this thing, but somebody would say put $100,000 down, and if they get a 60% tax bracket, they get a $400,000 write-off. Say put 100 in, I get $240,000 back in tax savings. Now, eventually, you're going to pay that, and you'd have to invest it. That would be an example. And if, and we'll go through the math. We have no bias, but usually they were not on sound grounds. And you looked at what you'd have to pay later when you recaptured. For those who are not familiar, you have to pay the piper eventually. The tax rates could have been higher or lower. But that's one example that comes to mind. I'm sure there are others. But, we've had long-term clients, and it doesn't come up that often. We're very candid right now. Sir?
John, you didn't touch on preferred stocks, particularly preferred stocks that are qualified dividends.
Right.
That answers some of the dividend questions, like a 6.5% preferred stock, which your bank or something of that sort. If you're in a higher income bracket, that'd be equivalent of 8%.
Right.
And it's a pretty stable company.
Right. I wouldn't touch them for any purpose. The reason is, when does it mature?
They have different maturities, but
When does it mature? Most of them.
some of them are hybrids that don't mature.
That's right. I don't like long-term bonds. I don't like bonds that are forever. That's a forever bond. And the tax laws, you're getting a little benefit with a qualified dividend, but that's factored in.
30%.
So it's a long-term bond, basically, often without a maturity, which makes it even less. And that tax benefit could get dissipated. And they're lower in the pecking order if there's a problem. That dividend gets omitted before they don't make a payment on the bond. And if you don't like long-term bonds because you're worried about interest rates, I sure don't want long-term preferreds. Now, there are some convertible bonds and convertible preferreds, and we'll do some things mathematically there. We found occasionally, and what's really fun, and with this audience, you guys would love doing this, I found occasionally convertible bonds that give you a right to convert having a higher return than the bond of the same entity that a conversion. There are, it's not huge, but there are market, things that happen, and that's fun when you find something. It's not a penny, it's not a zillion, but it's meaningful. So one part of what we try to do is find things that just look a little out of whack. Some people talked about closed-end funds earlier. We've had closed-end funds. Somebody talked about utilities at an earlier time today. I remember in the late 70s or mid-70s when Con Ed almost went under. I was wanting to buy a whole bunch. I was still mid-70s, just doing this on my own. But if you look at, you said utilities are having a problem, and you have a fund of utilities that was worth 100 units, it was selling at 70 or 72 cents. You're buying a stock at a discount, and it's diversified. So there are times like that. We had one that was a closed-end fund that was selling at over about a 16% premium. We started selling it. It made no sense. So there are times where you look at that, and those are fun to do because they're kind of gimmies if you pay attention. But I'm not in favor in this market. Now, if you had a situation where you thought rates were going to drop sharply, you have redemptions that could be way higher, and buying a preferred stock in that situation could make eminent sense. I remember being at Corning, I'll make it very brief, where I came up with an idea using preferred stock, and this is 1972, to use it with the tax advantage, which was 85% then, not the percentage it is now, much less, of using that and having bonds on the other side with debt, and it looked like a really good opportunity. There are times when that can make some sense. In an area where you're worried about interest rates going up a lot, absolutely have zero interest, personally. Yes, ma'am.
It's kind of interesting, in talking about diversification, but
Yes,
also trying to find the best financial planner. And one of the things that has come up, of course, in the last 10, 15 years are these Ponzi schemes. And amazingly, a first question should be, who is your auditor? I mean, to think that the auditor works for the company and then it's a brother-in-law or something. To me, that seems like a pretty basic question to at least
You've been
ask.
skeptical given what's happened out there.
Exactly.
One of the things, and again, I want to get on our side, we're here to be objective, but like if people come and ask us for references, we don't give it to people because our client names are confidential. And to me, if we did that, we'd be violating value. If a client wants to say something nice about us, I'll watch it. But even if they said, I remember doing this in 1978 and 79, I asked some clients if I could have permission to use their names. They all said yes. I never did it because I thought it was wrong. Because I'm taking a client situation and it's to my advantage. So somebody came in and said, I want to check references, and that's a good thing. I say, I'm sorry, I can't give them to you, it's confidential. So that would be a turnoff for you, but that's for a high values reason. You need to have confidence and do some networking. I mean, I think it's very important to be skeptical. Oh, one other point comes to mind with that. Who holds the assets? If the assets are held by the advisor, that's, for me, very uncomfortable. Okay, we have ours, again, it's not about us. They're held by Merrill Lynch, they're held by Morgan Stanley, they're held by Charles Schwab, in client name. So all we do is audit the broker. And that, to me, is very, very important because, you know, that could be an issue. That's not the only one, but that to me is a critical one, to have an independent in your name. And the investment manager might be able to put trades through and might be able to charge fees for the contract, but that's all they can do. And that to me would be one piece of it, which I should have mentioned earlier. But that's not enough. You need to do a lot more due diligence. Very good question. Anyone else before? No, way over. Yes, ma'am.
We have 5 grown kids, and usually the holidays we like to give them a little money.
Do you adopt?
Any other choices that would be good to maybe invest that money in for the 5 kids?
They have children?
Yeah.
I don't know. How about an overnight at Disney World? Not investment, to have a lot of laughs. It depends on the situation. You want to talk about it separately, it depends on the dollar amounts, and I don't know how to answer that in generic. I'm sorry to go way over.
No. I do this kind of Q&A, and at a certain point, I hope that it would be like a presidential press conference where someone is designated to say, "Thank you, Mr. President." And that's always the senior member of the press corps. I don't even know who that is, because Helen Thomas did it for so long. She sat there and read, and then somehow she'd know when it was time. But thank you, Mr. Ullman, for a great presentation. We have cocktails outside. So John is going to stay if you want to ask him a personal question or a general question. I know he'll be very happy to answer it. Please join me in thanking him.
Probably not because we want to leave room in case people had other questions or something. So Bev and what Art have done for us. We're here all day tomorrow. So if anyone has any questions, it's for St. Leo. So if you like any of the answers, please, thank you, Mr. Dr. Kirk, in any way you decide to do it. And what a great place. I mean, this is such a joy to be here. Thank you.
Thank you.